Hey traders, welcome to Charts and Coffee. Hope everyone is having a good morning. We continue to move through September. We're about a third of the way through, and on one hand, we know that there is an expectation for weakness. Now, what's really interesting, and I don't know how many of you like to read market history books, but if you go back into market history, the September-October phenomena of weakness dates back to when the country was mostly agricultural based. And what would happen in terms of cash reserves 8 months into the year as we go into the final quarter, basically, and some of the shortfalls that have happened. If you look at also some of the crashes in recent memory, they happened in September, October. So a lot of why, I'm not saying everything, but if we question the weakness in September, I would say at least 50%, I really want to say more like 80, is a self-fulfilling prophecy. So we're bearish because we're told to be bearish, so we're bearish, and then one begets more of the next. If we step back and look at what we have so far in September, we've actually already, in a lot of ways, defied. I'll show you right here. We actually defied a lot of the expectations. So when is the September weakness supposed to kick in? Let's take a look at, well, let's pull up the DIAs since I was just showing you the Dow. When is that September weakness supposed to kick in? And what have been the probabilities over the last 5 years? Now you'll notice the weakness in the Dow is not as great as the weakness in other places. I'll show you that in a moment. But here's your September movement. So if we're going to see movement, it's going to be right basically the next day or two. You can see where we start to top out in the next 3 trading days. So if there's a top, historically, seasonally, it shows it's going to happen this week. And then we'll move down to test possibly June lows or something. All right. Now, that's a possibility. What's another possibility? Let's take a look at the SPY. Now, there's a lot more fear behind what we'd expect in the SPY. Same thing, 5 years. Now, this is what a lot of folks are looking at. Now, notice if you look at the Dow, is it this scary looking? No, not in any way. The S&P looks, really, well, frankly, it should have been selling off already. Right? If you take a look at the seasonality, if that's what we're all going to decide is going to guide this month, the fact of the matter is it's really not in any way in line with where it should be. It should already be falling in a much bigger way. So let's take a look at that S&P. I'll use the ES futures for that. We had a little bit of a sell-off here. I'd say, Rog, isn't that maybe on par? It could be, but we're not seeing that dramatic leg. And you might say maybe that's going to be in the next 2 days. So what I'm trying to say is this. There is a timing to this. So if we're going to be bearish, let's look at if we linked up with the timing before and where would the timing be from today forward. And if you are a bear and if you're expecting that self-fulfilling prophecy or any trigger to do it, it's got to happen in the next 3 days. It's going to happen in the next 3 days. Now, here's the hilarious part of all this. If you think about the economic calendar, going into today, tomorrow, and Friday is also another tendency, right? So we have this seasonal tendency. We have another tendency we're going to collide with right now, and it's a bullish one, and it's called the pit bull low, right? So this is what I mean about tendencies and seasonals. We want to know what they could do. We want to have the levels. We want to have the timing, but let's just step back at the end of the day and just trade what we see. And right now, if there's going to be that next push lower on the S&P, that top and that weakness has got to kick in probably within the next 3 days, certainly going into Monday. And if it doesn't happen, we've kind of veered from those seasonal tendencies. Okay, so this is where we are in the S&P. We don't have a downtrend. We barely have any red candles. It's mostly neutral. And we're still stuck within the gold and the gray. Now, why is that important? The gold and the gray, whenever price action is within them, and you'll see there's a handful of times back during that yen crisis, August 7, August 8, once again on September 3, and then again on September 6th. Of all the price action we've seen in just over a month, only those candles, very few, 4 of them, exceeded the typical price movement range, which is to say most of the time, every other candle is operating within its 68% probability. So I'm going to operate with the knowledge that most of the time we're going to we're going to trade between the gold and the gray zone, which you could see is even with some of the most dramatic sell-offs we've seen in the last 2 months, we're still acting in a very, for the most part, normal way as we look at historical volatility. So this is where we are in terms of the overall movement. And this is what I'm going to continue to look at in terms of where the support is, where the resistance is. And if we have an opportunity to short in a neutral candle, it's not my favorite thing to short right now. So here's what I'll say. If I'm going to short something, I'm going to favor some of the weaker sectors. Am I going to short the indices? Right now, I don't think the clarity for what I'm seeing is in the indices. It's going to be at the individual sector level. I'm pretty bullish financials, although it had a tough response to the speech about Basel III yesterday. Healthcare is pretty strong. Semiconductors are actually quite weak. Energy is quite weak. So pick the right symbol for follow through one way or the other. So if we rally in the Dow, if we rally in the S&P, we rally in energies, I might want to take a look at that. If I'm looking for individual sector strength in equities, I'm going to stick with staples. I'm going to stick with utilities, but I'm also going to keep an eye on things like consumer discretionary. I'm going to keep an eye on financials. I'm going to keep an eye on healthcare as well. And by the way, healthcare and financials are much more tethered to the Dow narrative. And if you recall from just now, the Dow narrative isn't as weak as the S&P. So that's kind of where we're at in terms of the setup in this part of the month, where we are at least bracing ourselves for maybe that self-fulfilling prophecy of weakness to kick in. All right, so let's go ahead and take a look at our questions. Let's see what we've got. ES says, I like the IBM trade. I like the trend, ES. IBM has a trend, had a trend, has a trend. I like the trend. IBM's more tethered to the Dow than it would be any other index. So I've got some pretty decent Dow support, and ultimately, I just like the trend. And it's got another thing that I like about it. And I think you asked this question before we wrapped up in the Sector Secrets room yesterday. So we have this trade on in the Sector Secrets Mastery. This is a trade that we have on. There's a number of trades that we have on. This happens to be one of them. And if you take a look here, this is a recap of what we've got. And I shared this in the free video yesterday. Most of these trades are well on their way to third or just exiting on September 20 in terms of profit. But this gives you an idea of what we bought and where we've scaled out. And most of these are tethered to what has been the strength in gold, although I'm going to probably start tapping the brakes on that. Most of these are staples, Coke and Pepsi. We just entered financials. We have a number of members that are in TLT and XLY. So this is what and yesterday we had a day trade in the QQQ. So every day I send out this kind of recap of what we have open, all the entries that we have them open from. And ultimately, what the hope is that we're going to continue to find where the money is flowing, not where we wish it was flowing, but where the money is flowing. And financials, healthcare, consumer discretionary, bonds, those tend to be some of and of course, staples and utilities are up there too, but those continue to be where we have really great uptrends. And IBM was just another beneficiary of that, where we bought IBM 200 calls for $4.20. We had what we call an optional T1 scale out, which we alert out. We always know what the targets are going to be at the onset of the trade. You're not waiting for me to let you know that I scaled out of something after the fact. So we put those out to begin with. And the other scale out was either 535 or 665. I give everyone an optional. And that's really an opportunity to pay yourself a little sooner, if that's what you want to do, and move out of risk sooner. Because that T1 is probably one of the most misunderstood levels in trading. T1 to most traders is something like, look what the tooth fairy left under my pillow. Oh, 100% return on premium or any such absolutely ridiculous and random thing, right? If we look at T1 as our job is to manage risk, and can T1 be the level from which we do that? That's the way I look at T1. By T2, by T3, I could get a multiple, right? But take a look. I'll give you another example. Here's Pepsi, right? 355. My T1 was 575. Am I looking to double my premium or whatever else people run around telling people to do? No. But by the second scale out, I've darn near tripled it. So what will happen to traders who are trying to grow an account? They start off with very misguided notions of what T1 means. You might say, Rob, this first target, is that important? Oh gosh, yes, because the first target is actually the first step of risk management. And if you're wondering, why am I not turning the corner in my account growth? That could be a big reason why. How many of you are able to get a really good fill? Really good fill, plenty of time, and then you watch an unrealized winner turn into an unrealized loser. It's going to happen, but it shouldn't happen often, right? It shouldn't happen often. There should be a path along that movement in price that allows you to help grow your account, and then have a position sizing approach, a formulaic approach, a repeatable approach that allows you to take a third target or second or third target along the way of that follow through. So there's a lot of little things that will help. And kind of going back to the IBM question, it all starts with the watch list. It all starts with finding things that have the expectation for more follow through, that continuation. Will, you bought some JP Morgan? Yeah, Will, the reason I went and went with XLF versus JP Morgan is the candle, just that color of the candle prevented me. That's outside the rules of what I'm allowed to do. But same idea, you got the second strongest or second heaviest weighted stock in XLF. And, for me, it's really a matter of which of the candles did not go red. So I could not buy JP Morgan or Wells or Goldman or Morgan or Citi, but I'm in XLF. So I've got a little bit of a position in that camp of JPM as well. Look, if XLF is a rising tide, I would look for it to benefit the Dow. If the Dow's a rising tide, I would expect it to benefit the financials. Financials are the number one weighted sector. And if all that's moving, I would look to varying degrees for individual stocks to benefit. I just went with the tide over an individual boat. I mean, and if I was looking for an individual boat, I would love to get a piece of Visa. V is probably my favorite stock in that group that I want to get into. All right. So keep an eye on that one. All right. What else do we have here? Let's go take a look at the NASDAQ here this morning. And, I did not show you all the seasonals for the NAS. So let's go take a look at that. I'm going to play favorites. We looked at the SPY. We looked at the DIA. Let's take a look at the QQQ 5-year look back. And it looks a whole lot more like the S&P, doesn't it? Now, I do get a question quite a bit. Rog, if this happens, do you hedge? Remember, gang, there are certain things that traders do, and there's certain things that hedge funds do. And there's certain things that short-term time frame setups need, and there's certain things that longer-term time horizons need. Probably the biggest battle you're going to face, okay, as a trader. I'm telling you this right now because my mentors told me this from the get-go. Do not confuse your job for that of the TV analyst. That's a different job, different skill set. Do not confuse your job as a trader with being an economist. Doesn't matter. Recessions don't matter to traders. And yet all we hear about is recessions and whatever else. It really doesn't matter to a trader. What is a trader? Maybe that's where everyone needs to start. What kind of trader are you? If you're a day trader, hardly any of the news matters other than the timing of data releases and different Fed members, because your time horizon is today, and the calendar, the different events on the clock, will matter. All right. If you're a short-term swing trader, which I really probably consider myself most active in. In fact, that's been the most active part of our book. 1 hour or daily time frames with about a 2 to 10 day time horizon. I'm not even looking barely past September 20 right now. That's where the expiration is for most of our positions. So that's my window. Can I manage the winners? And we have quite a few. Can I manage the winners into that expiration? And in the meantime, are there other setups in the stocks that I like where I might consider, say, the October expiration, going further out, further down the line? So that's where we're at. But I'm never thinking about where are we at the end of the year, never thinking about 6 months or 1 year from now. Could there be a more meaningless conversation than that of a recession to a trader? Yes, there is one. The yield curve. That's about as galactically misleading and useless a conversation to a trader as there is. The yield curve has been inverted since 2022. It's 2024. And then I look at this year, right? Look at this year. And I don't want to be salt in a wound, but sometimes we just need to hear it. This has been the best trading year for me since 2021. I mean, let's just face it, 2020, everybody made money. This has been a year to make money because for the first 3 months of the year, we had a straight up uptrend. From basically May to early July, we had a straight up uptrend. We've had a few brief periods of chop. If we treat the chop like an uptrend, we're going to get burned. But if we presume that the uptrend is done and we're never going to see higher highs again, we leave. It's an opportunity cost, right? So all the discussion of inverted yield curves designed to scare you. Oh my gosh, we're going to crash, designed to scare you. And not acknowledging the overall trend. Again, this has been a really good year for account growth. When I see you all on the 24th of October, I'll show you. A lot of you know that the first 3 months, I think when we did our class in Q2, I shared that. But what's been happening since? August wasn't straight up. September wasn't straight up. We made money in August. And we're actually up pretty nicely in September as well. Because just because the NASDAQ isn't moving higher doesn't mean other things aren't. Right? Gang, if you're still wondering how to prepare for a crash and how to hedge, right? And what's going to happen if we fall to, I don't know, 5,000 on the S&P or whatever, you're missing out on what's happening now. And that's really where I hope everyone is focusing on where there's follow through. And did I say October 24? Yeah, September 24, and actually less than 2 weeks. September 24 and October 2nd. I'm going to share with you all what we're actually doing in the mastery, the kind of trades we have on like this, why we're doing what we're doing, and how we're able to take advantage of this to grow an account, right? Does hedging help me grow an account? If I'm looking at a 2 to 10 day time horizon, why would I need to hedge? Just put a stop loss in. And even better, be in positions that have a better opportunity to continue to rally if there is that fear event. Do you notice that XLP, which is we had most of our exposure in August in things like healthcare, utilities, staples. You notice that XLP didn't in the least have an issue with the end of the world crisis with the yen. In fact, it benefited it, right? Same thing with gold. So think about where the money is going to flow if that calamitous thing happens, and you'll get really good at watch list building for account growth, right? Not watch list building so I can trade my favorite stock and have to hedge it because it's not a relative outperformer. And these are tough things because you're going to have a different conversation out there on the interwebs, and it's going to be a different conversation on television. But yeah, I did mention the 24th. So yes, the webinar is on 8 p.m. as they always are. 8 p.m. So this is going to be September. I guess I got to get these out here. I don't know when we're going to have the link to sign up, but that's a 8 p.m. webinar, 8 p.m. Eastern. And then we'll get together to keep the convert. Now, we don't do the same webinar twice. On October 2, we'll have another one where I'm going to keep that conversation about, how do you grow accounts? This is really about account growth. This is about small account growth, which I know a lot of folks have been asking me about, but this applies to any type of account. So hopefully we'll have the link next week. But if you're struggling with turning the corner of building your account, right? How do you position size to be able to take advantage of, these kinds of things? Coke at $2.08 to it's trading at 4 something right now. Pepsi $3.55. We've scaled that at $9.50. These are really low cost options. I'm not talking 20 and 30 cent options, but lower cost scalable options. And those are the kind of things that I'm going to talk about later on this month. So 2 weeks away, pretty stoked. Ren at 8 p.m. Thank you so much. And remember, gang, it's okay to question a lot of the dogma in trading. Much of it isn't true. It's just repeated. Kind of like this notion that September is supposed to be a terrible month. It's sort of a self-fulfilling prophecy. Be aware of the timing, like we talked about, and then see if it actually happens. And then we'll see where the trading opportunities are. Remember, we're not economists. We're not playing 6 months down the road, at least not most of us. We're trading for usually a 2 to 10-day time horizon. Know your job, do that job, and this becomes a whole lot easier and a lot more fun. Be good to each other, gang. I'll talk with you soon.